Today I'm happy. And you know what that means? It's time for a bit of financial mischief. Today, I bring you something that I've been waiting for all week. And I promise you're going to love it. Because today, we're going to talk about three key things: the current state of liquidity and what it's telling us about the markets, the collapse of the digital euro and the failure of the European Central Bank, and finally, Bitcoin, fear, and opportunity. All three are connected, and if you stay until the end, you'll see how they reveal the same underlying truth: that the entire financial system runs on liquidity, confidence, and control. Let's start with liquidity. Everyone's been asking, how do I track liquidity? How can I tell when it's rising or falling? Well, the answer is simple. Look at the bank reserves held at the Federal Reserve. Right now, liquidity in the United States is contracting. Commercial bank reserves have dropped below $3 trillion. And this week, they hit $2.8 trillion. That's important because every time U.S. liquidity contracts, the stock market tends to correct. So we need to pay very close attention to this chart. At the same time, the yield on the 10-year Treasury bond has risen above 4% and is now approaching the 4.20 to 4.30% resistance zone. What does that mean? It means that, in the short term, bond yields are likely to rise a bit more, and that could put downward pressure on equities. So yes, a correction is possible. But is this the end of the bull market? No, not yet. Now here's something fascinating. For months, this rally has been driven by retail investors, not institutions. Fund managers and hedge funds stayed on the sidelines. But according to the latest Bank of America survey, those institutional investors are now buying again. And since I'm a fan of the contrarian opinion theory, I'll tell you what I think. When institutional managers finally start buying, that's usually when the market is near a short-term top. The AI Sentiment Index shows bulls now outnumber bears by 7 points. That's not extreme, but it's worth noting. The last time this difference reached 9 points, the S&P 500 kept climbing anyway. So yes, we might see a pullback, a cleanup phase to shake out the late buyers, before the market resumes its upward trend. The Fear and Greed Index still shows fear, not euphoria. That tells me we're not at the top yet. My conclusion: a minor correction is likely, but the uptrend remains intact. But now, it's time for the fun part. Because the real mischief today comes from Europe. Let's move to Europe, where things are not going so well. Because what's happening inside the European Central Bank is nothing short of a disaster. They just announced that the digital euro, which was supposed to be the future of European money, has been postponed until 2029. Why? Because after years of meetings, debates, and billions spent on research, they still have no idea how to implement it. That's not my opinion. That's reality. They don't know how to make it work technically, how to guarantee privacy, or how to convince citizens that it won't become a tool of financial surveillance. And that's the problem. Europeans don't trust the system anymore. After the COVID restrictions, after inflation, after watching their savings melt under negative real rates, people are done believing the official narrative. And honestly, who can blame them? They were promised stability. They got inflation. They were promised digital innovation. They got bureaucratic chaos. They were promised monetary sovereignty. They got dependency on the US dollar. Let's compare. The United States already has a fully developed digital dollar infrastructure. China has been testing the digital yuan since 2020, and it's already being used by more than 200 million people. Meanwhile, Europe is still writing reports. Do you see the problem? The ECB is technically behind, politically divided, and strategically irrelevant in the global race for digital currencies. And here's the irony. They keep talking about monetary independence, but they can't even build a payment system without relying on American technology companies. This is why I say the European Central Bank has failed, not just in creating the digital euro, but in its entire monetary strategy. They've lost the most important war of the 21st century, the war for monetary power. And in that war, there are only two real players left: the United States and China. Europe? It's not even on the board anymore. But here's the most dangerous part. They're not just losing technologically. They're losing politically and philosophically. Because in their obsession with regulation and control, they've forgotten what money really is: a tool for freedom, exchange, and trust, not for surveillance and manipulation. That's why the project collapsed. Not because of lack of technology, but because of lack of vision. But while Europe sinks deeper into bureaucracy and fear, The United States keeps expanding its economic and digital dominance. And that brings us to the third part, where we'll talk about Bitcoin, about fear, and about how the collapse of the Euro digital project is opening the door to a completely new financial paradigm. Now that the European Central Bank has failed with the digital euro, let's talk about the one currency that they can't control, Bitcoin, because that's where the real fear lies. Central banks all over the world are terrified, not because Bitcoin is perfect, but because it's outside their control. They can regulate, restrict, or ban, but they can't stop it. Bitcoin doesn't ask for permission, and that's exactly what makes it dangerous to them. You see, the ECB wanted to build a safe alternative, something programmable, traceable, and centrally managed. A digital currency they could monitor at every step. But Bitcoin? It's the exact opposite. It's decentralized, open, and mathematically limited. That's why it's not just a currency. It's a statement of freedom. And that's why they hate it. Because it reminds them that money doesn't belong to the state. It belongs to the people who create value. Now, let's bring this back to liquidity. We live in a world completely addicted to it. When liquidity rises, markets go up. When it contracts, everything falls apart. The central banks know this, and they use it to control behavior. They inject liquidity to create optimism, and they withdraw it to create fear. It's a form of psychological manipulation through money supply. That's why, even though inflation is under control, they keep the system dependent on liquidity. It's not about economics anymore. It's about obedience. And that's where Bitcoin comes in. Bitcoin breaks that cycle. It can't be printed, can't be inflated, and can't be stimulated. It exists completely outside of their game. And that's what makes it the ultimate antidote to fiat corruption. When the euro fails, when trust collapses, when liquidity dries up, Bitcoin remains. Because Bitcoin isn't about getting rich. It's about staying free. So where does this all lead? To a monetary realignment. A world where traditional currencies lose credibility. And people look for alternatives, real ones. Some will go to gold, some to Bitcoin, and some will finally realize that the system they trusted was never designed to serve them. That's what's happening right now in Europe. The ECB failed to deliver innovation, so the market will find its own solution. They wanted to create a digital euro to compete with the dollar and the yuan. Instead, they created the perfect marketing campaign for Bitcoin. So, let me leave you with this. When a system becomes too rigid, too centralized, too obsessed with control, it eventually collapses under its own weight. That's what's happening to the European Central Bank today. And that's why Bitcoin keeps rising, not in price, but in relevance. In the end, the failure of the digital euro is not the end of innovation. It's just the beginning of monetary freedom. If you enjoy this kind of macro analysis, clear, independent, and free from headlines, make sure to subscribe and like this video, because understanding the system is the first step to protecting yourself from it.